The Alliance leads and facilitates the work of a group called the President's Council on Impact Investing, which is a group of 20 US foundations who are leading in impact investing. And we convene their presidents, we convene their senior staff members. And so we have a bit of a front row seat in terms of the practices of these foundations. Together, I think their endowments total about $90 billion. It's co-chaired by Don Chen, who's president of Cerdna Foundation, and Tanya Allen, who's president of the McKnight Foundation. And I would say one of the most important takeaway from working with this group over the last handful of years is that philanthropies need to leverage all the tools in the toolkit to drive impact. We know that most foundations are very skilled at deploying grant capital for impact. We call on them to deploy some of that grant capital to scaling the impact investing field itself. Some of them engage in public policy, many of them don't, but it is, fundamentally important. Catalytic investment capital through program-related investments and guarantees and other things are, we think, essentially important. And then, of course, it's leveraging the endowment for impact. The catalytic capital movement got turbocharged, I think, by the Catalytic Capital Consortium, which was a grant-making organization, donor collaborative between MacArthur Foundation, Rockefeller Foundation, and Omidyar Network. They did an incredible amount of funding to support the research and practice of catalytic capital. And MacArthur coupled that with their own their own investing of catalytic capital to try to seed catalytic fund managers across the world. My sense is that PRIs are not more universally practiced in part because they are perceived as risky. Some see program-related investments which come out of the grant budget as potential jeopardizing investments, and they can be fearful of jeopardizing foundations' charitable tax status. The program-related investment examples at the IRS were updated relatively recently to include even equity investments. And so I think that foundations actually have more latitude. Sometimes they don't have the skill set in-house. And so that can be a barrier. We published a piece of research called Impact in the Balance, leveraging foundation balance sheets for impact. And maybe one of my fantastic staff members who are on the webinar can put that in the link. But we call on a program an increase in program-related investment, but also guarantees and other ways to leverage both the asset and the liability side of the balance sheet. So there needs to be more. There's a lot of innovation and talk about it. It can be difficult. And so what I see the need for is catalytic investment vehicles that can help program-related investment. So for example, I think, Stephen, you're on the line from Social Finance has an impact first fund of funds. That's an example of a way to decrease the barrier to underwriting of individual PRIs, so to go into a pooled vehicle like that. There's another entity called TrimTab, which is doing some very interesting catalytic investment work through a very innovative company structure versus a fund structure. So I think for those that want to toe dip, going into some of these pre-existing vehicles can be very helpful. And you can get a front row seat on those diligences and maybe re-up where something really aligns with a foundation's interests. So I think the catalytic investment market is coming up with more solutions that I think could make catalytic capital investment more practiced.